Let's dive in more and discover the present value and discounted cash flow analysis concepts. Um, as we saw, compensating investors by offering return for their willingness to wait is fundamental. In next slides, we will go into detail what is an appropriate cost of capital and appropriate discount rate. But before getting into this, let's think about the cost of capital by using the concept of the interest rate. Okay? If you put money in the bank and the interest rate is 10%, in case of depositing $1 million today, 1 year from now you will end up with $1,100,000. Well, if we know that investors should be compensated and what is the discount rate, we can calculate present value. And as you will see in the present value calculation is opposite to the future value calculation. As you already understood, the finance is worried about future. As a science, finance is fundamentally forward-looking. Okay? And this demands to discount future cash flows to present, and it is opposed what happened in the past. So we need to forget about sunk costs. We know that accounting that feeds us with all the information we need is based on the past facts. We, using that information, should estimate future and try to understand how much the business will make in the future, or how much the investment that I'm making will earn in the future. And here the present value concept is an important concept that helps us to understand that. In case of the future value analysis, we have the present value, and using the return rate, we arrive to the future value. So we have the present value, we use the rate of return to calculate the future value. In case of the present value analysis, we know what is the future value, and using the discount rate, we calculate the present value. We discount and we understand what is the present value. Okay? So, important components here is present value is the value today of future cash flows, and discount rate is the interest rates that we use to compute present values of the future cash flows. So we discount future cash flows to the present and understand how much those future cash flows worth today. As you realized, present value is opposite of future values. If you remember, in calculation of future value, we deal with compounding. So we have present value, we have rate of return, and we compound to future value. In case of the present value, we use discounting. In this case, we calculate and understand the present value by discounting. This figure provides a good visual representation of discounting and compounding, and you can understand here very well that calculating the present value or future value, there are the opposite scenarios, if in case of the compounding, we know what is the present value, and we are compounding to figure out the future value, well, in case of the discounting, we just do opposite. We have the future value and we try to calculate present value. So this way we can easily understand the basics of the present value and relate that to our previous lecture that we have in future value calculations. Okay? Well, there are two ideas to take into consideration when we discount economic returns. First one, how to think about future and translate future cash flows into the present. Well, here the discounted cash flow analysis comes to help us. The second question is how to make investment and valuation decision based on discounted cash flow analysis. And the bottom line is that indeed discounted cash flow analysis is a gold standard, and discounted cash flow analysis helps to understand the value of the business as the present value of the all future cash flows. Modeling good discounted cash flow analysis is difficult and it will take time and energy, but before putting all effort and calculate discounted cash flow analysis, always second guess yourself. Okay? Ask the question, is this a good and sensible assumption about revenue growth that I'm making? Second, is this a good assumption about margins that I'm making? Third, is this a good assumption about the terminal value that I'm making? And lastly, is this a good assumption about share counts of the business? Well, if all these assumptions are correct, well, the discounted cash flow analysis will provide us excellent results. And as I said, it is a gold standard and it will help us to compute present values. To conduct discounted cash flow analysis, we look ahead into the future. First important part. We forecast free cash flows into the future. And finally, we discount them back to the present. So these are 3 steps to use in discounted cash flow analysis. And that present discounted value, in fact, is the value that asset worth today. Okay? Well, I hope you enjoy learning about these fundamental concepts of finance, and we will dive into details of discounted cash flow analysis in next lectures. Enjoy rest of your day. Thank you for your attention.